Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today I'm joined with Anmol Singh. How you doing today, Anmol?
I'm doing great. Thanks for having me.
Good. Well, Anmol, why don't you tell us a little bit about your background here?
Yeah, definitely. So I've been trading the stock market since 2010. So on my 13th year now. Started in the early days of my college, and I've been doing that ever since. So, and I also run live traders, which is another way of guiding other traders how to get involved with the stock market. So primarily that's my background, mostly involved as a day trader as well as a swing trader, and then also have angel investments in about 32 different startup companies. That's more in the private sector.
So tell me what got you started in trading to begin with?
Yeah, just like I think every other kid, I was in college, went to Brunel University in London, and in the UK, you have to before you graduate, you have to have like 1 year's worth of work experience. So on my second year, I started looking at what I can get at different jobs in or different sectors, and unfortunately, I didn't get a single job, or not even a single internship. So I was just stuck in my dorm room, figuring out what I need to do. And I think growing up, every guy, has the allure of the stock market, and I was bitten by that bug early on. So I started just researching, reading a lot of books, and diving into the stock market. And I joined a prop firm in New York City while I was still in my dorm room in London. Started trading for them, and then have been doing that ever since.
Nice. So joining a prop firm allowed you to graduate? Is that what you're telling me?
I know I would have graduated anyway, but you needed like 1 year of work experience. But when I joined it, so right after college, I just continued, trading for them
Oh, okay.
until 2015 when they got bought out, and then I decided to go off on my own.
Nice. So what do you find, is appealing about kind of day trading? Because I mean, some people are buy and hold and some people are traders. Like what to you is kind of like the appeal?
Yeah, I think I like all forms of investing and trading, but day trading is more what I call the income producing style, because investing is great, but you're not going to pay your bills off investing. You can't live off it. That's more like a wealth building where you're taking an account and your goal is to continue to grow it. But if you want to do this for a living, then you have to have income coming in every week or every month. So that's what got me into day trading, so that I could day trade, make an income, live off it, and then use my profits from my day trading percentage of that, which I automatically invested. So that way I have both the wealth building style and the income producing style.
So help me understand though. I mean, you're talking about the day trading as being income, but why does it matter if I mean, trading is trading. If you're making money or not making money. So what's the difference between investing and trading?
Yeah, with investing, I mean, it's more for the long haul, right? You're looking at the yearly returns, and typical investor returns are 10 to 12% a year. So unless you're trading with, tens of millions or hundreds of millions, you're not going to get any income off it, right? It's more so to grow an account. So for an income style, you need to have, profits coming in on a predictable basis on a monthly basis. Whereas investing is more so on the long term.
Yeah, I guess what I'm saying, and 10 to 12% is, I guess that's coming from a guy who started in 2010 and missed all of 2008 and 9. 10 to 12% is kind of I think, well, let's just say it's an anomaly in market
Right.
history. But I guess my point is if you're making so much money day trading, why need to invest? I mean, I assume you're making more than 10 or 12 in day trading. So
Absolutely. Yeah.
why stick with a lower return if you can day trade and make a much higher return?
Great question. So I think day trading has a cap on it. Like there's a certain amount of liquidity every single day. So even if I wanted to, I can't buy 10 millions worth of shares at one go, right? Because it's going to move the market, it's going to move the price. So it's not as scalable. Whereas investing is really scalable. You can scale up until billions of dollars and not even find what the limit is. Whereas with day trading, there's a limit to a certain amount of stocks you can trade, the liquidity of it. Can you get in and out every single day with the amount of shares? So there's usually a cap on day trading. You're not going to get that with investing. So that's why, you can't day trade with all of your money. And it's always good to have certain amount of profits that you make from your day trades automatically invested. So now you have your money working for you rather than you having to day trade every single day. Because with me, if I take a 2 month vacation and I'm not day trading, well, that part of the income is going to stop, right? Whereas I still have my investments working for me.
So, yeah, and that's a great point. So let me ask you this: what do you invest in, or let me frame that?
What do I invest in?
What do you trade? Like, what specific securities do you trade? Because obviously, some have more liquidity than others.
Yeah, so I mean, I usually focus on what's moving that day, what's in play that day, because I'm only focused on the first 2 hours as a day trader. I'm not day trading all the way till the market close. I have a strategy that specifically works only in the first 2 or 3 hours. So I'm typically my goal is to get done by 11 a.m. So I would only be focusing on stocks that are in play that day, which would mean any stocks that are in the news. They're either gapping up, opening higher, gapping down. Either there's earnings, either there's some sort of an upgrade, because those stocks will have high volume on that day because of the news event. So that gives us the liquidity to be able to in and out with a decent amount of size. So always different stocks every single day. Although I do have my favorites like Tesla, Meta, Microsoft. Those are like my go-tos every day that I use option strategies on a daily basis.
Okay, so that kind of brings it to the next one is what vehicles do you use? You said you use options, do you trade stocks? Like, do you have kind of like where do you stop with that with the different vehicles?
Yeah, so in early in my career, it was pretty much 100% stocks, right? Options I only started incorporating as of like 2016. But recently it's been more and more of my, the day trades that I take. So now it's like 80-20. 80% of my day trades are options trades, and 20% of them are actually using the stocks. But it's primarily the, NASDAQ, NYSE, the big cap stocks. I don't really focus on penny stocks, or I don't really focus on those not so well-known names because they will also have low liquidity. So it's mostly the well-known names that we're focusing on every day.
Okay. So what's your style? Like you mentioned earlier, you day trade, you swing trade. Like tell us a little bit about your style.
Yeah, definitely. So I divided my trading into like three different buckets. So in income producing style, there's two types. One of them is day trading, the other one is swing trading. So with day trading, I'm pretty much only using options these days, as I said, 80-20. And that's a very scalping style. I'm only looking to capture these micro moves with a decent contract size to be able to profit off that. And then I have swing trading, where I might be holding on to stocks for maybe a few weeks, a few months. Like the last trade we had was a Tesla. So I think that one we were in it for about 3 weeks. So that would be my swing trading style, which is, all of it's based on technicals. I don't really use fundamental analysis in my trading. It's pretty much based on chart patterns that we have back tested over the last, several years that have a certain amount of statistics that they work for. And then the other style is called core trading. So core trading is the alternative to investing. The only difference is, instead of using fundamentals, we're using technicals like a monthly chart, a really, really higher time frame chart, where typical core trade could be several months to several years at some points. So those are three different ways I trade: day trade, swing trade, and core trading.
Okay. So is core trading, would you kind of define that as more like trend following or
Yeah, that could be trend following. A great example is just buying the monthly 50-period moving average, right? Historically, if something is in an uptrend, buying the 50-period moving average has been proven to work really well. And even take a look at Tesla when it dropped down to 100. If you look at the monthly chart, it was right at the 50 simple moving average, and we bought it about 110, 120. And as of now, the Tesla was trading around 260s.
so all right. So if you're looking at so explain your monthly moving average concept, the 50-day moving average to me, because I understand what you're saying, but I'm not sure the listeners will understand the way you're explaining it.
Yeah, definitely. So, I'm oversimplifying it right now. It's not as simple as just buying the 50-period moving average. But on a monthly chart, if you plot out the 50 simple moving average, which is just the average of last 50 months, historically, if something is in a trending phase, whether it's just uptrending, and all the pullbacks you would notice coming down into the 50 simple moving average usually tend to get bought. The same thing happened with the Nasdaq. Same thing happened with the S&P 500 in October of last year when we got that 35% drop. But if you open up a monthly time frame chart, you would have noticed that that pullback happened at the 50 MA, and from there we've gone back up. So that's, in a nutshell, that would be the easier way to simplify it. But there's also other patterns and strategies we're looking in order to confirm that bias.
Okay. So how do you determine which is the best strategy to use with which instrument? Because different stocks operate on, different metrics, different moving averages, different, technical strategies, so how do you decide which ones to choose?
Yeah, great question. So, we have several different tool belts, as we call in our playbook, several different patterns, seven different strategies, and they're almost like a picture, right? So we're memorizing almost like a pattern. Here's how it looks. So our goal is simply to spot that pattern, which pattern it is on the chart. Case in point, like consolidation is a very simple pattern for most listeners to, learn. Consolidation is simply where a stock is just going sideways. It's not really going up or down. It's moving between two price ranges. And then we're looking to buy the range expansion, which is also known as a breakout, when it finally exceeds that range, and usually will continue on to another uptrend. So there's many different strategies to use. Which one to use would really depend on which pattern is actually setting up on that chart, and it's going to be different ones for different market conditions as well.
Okay. So tell me a little bit about how you use options, because I mean, options is a big rabbit hole, and people use them in different ways with different strategies. So how do you use them?
Yeah, so I think most people that I see online, at least, use it incorrectly. They're using it as a leverage tool, right? They're using it to get these big gains that might be plastered all over social media, because most people don't post their losses, right? They post these big option gains, and people come to options usually with that mindset. That's the absolute wrong mindset to come with. So all we're trying to do is, instead of using the stock, we're trying to use an option. The only difference for us, it would be that less amount of money is being outlaid. So if you buy 100 shares of Tesla, right, you might have to spend out a lot of money. Whereas if you buy one contract of Tesla, which still gives you the right to 100 shares, then the actual money you're putting in is usually like less than a fifth of what it would cost to buy the stock. So that's the only way we're using it for. And when it comes to day trading, I'm purely scalping. It's a very fast style. I don't really recommend it for most newer people coming in because it's really fast. We're micro time frame, 1 minute charts. We're trying to time a reversal, which is a strategy that we've been pretty good at and we've tested many, many years ago. So we're only looking to time that reversals using, weekly options or the next month out options using at the money. So at the money would, for listeners who are not familiar with it, would be if a stock is at $100, and if I buy $100 call option, that's at the money, same price as what the stock is. And we're looking to use those options to just scalp those micro moves. And typically a scalp would be 30 cents on an option, which if you're buying 10 contracts, that's $300. So if you're buying, 30 contracts, it'd be $900 and so on and so forth. And we're looking to do that multiple times a day.
Okay. Now, what's the length of time you look for your options contracts? You looking 1 month, 3 months, 6 months? What are you looking at?
Yeah, the sweet spot for me is about 2 weeks. So I don't want to buy too less of a time, like 1 week, because then I have to be right instantly. If I'm wrong, then the time decay or the theta decay goes against me. So I'm looking at about 15 days for a typical scalp. And usually I'm not in a scalp for more than 10 minutes. If I am, then either I'm being stubborn or either the trade's going against me and, I haven't decided yet what to do on it. But, typically it's about 15 days is what I'm looking at.
Okay. So you kind of got into an area that I think is really important when it comes to trading, which is kind of mindset and systems. So you mentioned you stick with it for 10 minutes unless kind of you're stubborn and it goes against you. And this kind of gets into the psychology of it. And this is what makes trading so challenging. So tell me a little bit about the mindset. Like how do you structure your thinking so that you can be successful as a trader, where most people fail?
Yeah, great question. So the way I try to stay objective in the moment is by actually having my statistics. So every strategy that I use is not on a whim. It's not on like a gut feel, right? That's where most people mess up, is they haven't back tested a strategy. They don't have statistics for it, right? If I ask them, okay, how did this strategy perform over the last 6 years? What's the win-loss ratio? What's the expectancy? What's the Sharpe ratio? They would have no clue. They're making decisions on a whim, which is the absolute wrong way to trade. So for me, every strategy that I'm using has been back tested over several different market environments, in a bull market, in a bear market, in an earnings environment, a non-earnings environment. How does the strategy perform? And I have hardcore, statistics for it on a spreadsheet. Right? I always tell people numbers don't lie, right? So the numbers are there. So if a strategy is shown to work, let's say 60% of the time, right? That means, well, 6 out of 10 trades are going to be winning. Now, if an average winner is twice the size of an average loser, then I know the strategy is a winning strategy. So I have utmost confidence in pulling the trigger, taking the trade. And at the end of the month, the statistics will take care of themselves. And usually it's around the same ballpark that we've back tested, plus or minus a few percentage points. So I think having those numbers, you accepting those numbers, gives you predictability of what to expect. And when you have that predictability, you're going to remain calm, you're going to remain confident, you're going to follow your plan. Usually people break their plan because they don't know what to expect. They haven't tracked it. They don't know what's the win-loss ratio, how many are going to win or lose. And that's when people often get holding on to a stock that's going against them, and the buy and hold approach turns into buy and hope, and hope is not a strategy. So
We say that a lot in this show. So yes, that is very true. So I have to ask. I mean, you talk about having a strategy, but as the infamous quote from Mike Tyson, everyone has a strategy till they get punched in the face. So how do you handle when your strategy goes against you, or just like anything, you go to the casino and you get just a string of bad luck. It happens sometimes. So how do you handle things like that psychologically and in terms of your financials?
yeah, I'll tell you first how I handled it in the beginning. Not very well. When I started, I was new to markets. The whole first year, I lost money trading. Every whole first year, didn't make a single dime, right? And that's because usually when a trade was winning for me, I would get out too soon, right? I would get out before my plan told me to get out, and then losing one, I'd keep holding, hoping it'll come back up, right? And that was the absolute wrong way to trade. So I had to work on myself a lot, like the first 3 years at the prop firm. The good part was the prop firm actually instilled discipline in me because we had loss limits. Hey, you lose X amount this week, you come back next week, you can't trade anymore. They'd lock you out of the platform. If you lose a certain amount in a day, your platform will shut off automatically and you can't trade anymore until you get approval from the CEO of the company, right? So that was forced discipline. That gave me good habits of knowing when to fold it, knowing when to hold it, as the Kenny Rogers song goes. So I think that was one of the things to really learn. And then there's a lot of different things, I call get up and walk away. If something is, going against you and, you feel like you might go on a tilt or you might do something that you've not, planned for doing, get out of the trade, go around the block, come back. And if you still like the trade, you can always get back in it. But the worst thing to do is holding on to a trade, right? So I always teach people to just get out, go around the block, take a walk, come back. And I'll look at objectively, the strategy is still there. If you still like the trade, get back in it, but don't keep holding on. So learning how to stay objective in the moment is the biggest thing that people can work on. And, I would love to give an easy way. There's no easy way. You just have to work at it. You have to, be calm. You have to be mindful. Meditation helps a lot. Visualizations help a lot, and just being in the moment, looking at things objectively rather than emotionally, is the best way to do it. I'm very unemotional when it comes to my trades. I'm usually very detached. So then I know if I'm being stubborn, that's out of the ordinary, that I have to get out of the trade, because usually I don't do that, and that serves me really well when it comes to trading and investing. Being completely unemotional, it doesn't help in relationships, but it helps in trading and investing.
I was just gonna say you're gonna make some girl a lucky gal. I'm being unemotional.
Yeah.
um, so so let me ask you so when it comes to uh, day trading, swing trading, a lot of different trading strategies, a lot of people use computers or algorithms or systems as a way to remove the emotion from the trades. Um, so it sounds like you do it more manually. So why not use systems and computers to remove that emotion so it doesn't affect you?
No, I absolutely believe in using systems and stuff. Now, when it comes to options, I do it manually just because, I'm not a programmer. I don't have the know-how on how to build it. And plus, it's also in the boat of, hey, I've been doing it for 13 years. It's working. Why fix something that's not broken? Why add another variable into the mix? But when it comes to stocks, we absolutely use algorithms. We have our own software we call the Money Badger. It's like a trade management software. So we use that for stocks when it comes to swing trading or day trading stocks as well, where all we have to do as a trader is to identify the pattern, right? We put in the entry prices, our exit prices, right? The stop losses, and we'll put in how much money we're willing to risk on the trade. And then we have multiple programmed exit strategies on the software that was just check boxes. You just check box which strategy you want to use. You click manage, and now you can walk away, and the software manages the exits for us. So when it comes to stock trading, all I have to do is find the entry, find the right trade, and the software will do the exits based on the criteria that I've already provided it on the algorithm.
Nice. So how much time every day do you spend trading?
I trade from 9:30 till 12, but typically, really, I only trade from 9:45 to 10:45. Rest of the day, I'm usually running a live stream, kind of talking about my trades with people, and going over all that kind of stuff.
Nice. Nice. It sounds a little more relaxing than I imagined, where, people are stressed out all day, pulling their hair out, watching the screen. It sounds like it's just You put stuff in, you leave it, and then go do other stuff.
Yeah, because I mean, I traded for a prop firm and I saw the other side of it, right? Like people who were burning out, you would hear keyboards flying, you'd hear mouses flying, you'd hear, words flying as well. And that's when I realized I can't do this. Like, I can't do this for a living forever because I've seen the toll it takes on people at the prop firms and people who've been way better traders than I am, right? But it's not worth it, what they go through every single day. So I created a strategy which specifically works in that time frame because I know I could be really focused, really energized, really disciplined for that 2 hours. I can't do that all day long. I'd burn out. So I think
Yeah.
I've created a strategy that I can only do the first 2 hours and call it a day.
So tell me an example of a kind of bad streak you went on, how you handled it and what happened, just to kind of give the listeners an example of what can happen with day trading.
Yeah, I think the worst was it was like 3 years ago. It was August. It was a summer slow month. Nothing really was moving, and I was just forcing trades. Really, I was trying to. There was nothing out there. There was no patterns. But I was like, hey, I gotta do this for a living. I gotta make something. So I was forcing trades, which we call manufacturing trades, trades that don't exist. You're just manufacturing them out of thin air with your mind. So I went on like a 15 trade losing streak, which rarely happens. But it was like 15 trade losing streak, and yeah, I remember how I felt really down. I felt like, oh my God, is the strategy changing? Have the markets changed? Started really doubting myself. But then I just, kept going. And that's where surrounding yourself with other like-minded traders really, really helps. Because they were like, hey, like, just keep doing the same thing. Don't change a thing. Let's do it for another month, see how it goes. And sure enough, after the 15 losing streak came one of my biggest winning streaks as well. So statistics always end up reverting to the mean, right? If I'm coming after a big winning streak, usually I'd get a string of losses after that. But the ratio of, let's say, 6 out of 10 trades in a long enough sample size that seems to work, prove itself true all the time.
So tell me a little bit let's go back to the mindset piece, because what you're doing with day trading is maybe a little bit more concentrated version of this, but investors, even long-term investors, have the same challenges. So tell me about some of the mindset challenges you've faced and how investors can overcome them.
Yeah, the mindset challenges, what I face and what I notice other people do all the time, be it traders or investors, is not having a plan, right? They know exactly which stock to buy, right? When to buy it, but they have no idea when they're going to sell it. They have no idea when to get out, right? So even if it's going in their favor, they don't know when to get out. Like we saw that in 2020. People were in great stocks like Zoom, Roku, even Kathy Wood's ARK ETF, right? And they saw thousands of percentage of returns, but they're still holding on to it now, right? So they didn't have a plan on when to get out. So I think that's the biggest problem that I notice investors especially make, is not knowing when to exit the trade. Like, I mean, Zoom, Spotify, Roku, all those stocks, when they hit their all-time highs in 2020, most of them are never going to come back, to that all-time high price. They might go up, they might get nice bounces along the way, but in my opinion, they're never coming back to their all-time highs. So that's a missed opportunity for an exit. The other thing is, if they're wrong on their investment, let's say they make a wrong decision, now now they've become long-term investors. They're holding on forever and ever, maybe even averaging down, trying to get their dollar cost average, but they have no plan on, hey, if I'm wrong on my investment thesis, when do I get out? They don't have that plan. So I think planning your trade, just like you won't enter a business without a business plan, you shouldn't enter an investment or trade without a trading or investment plan. So I think that's number one priority. And then also knowing your risk tolerance. How much are you willing to lose on it, right? Because nothing's a sure thing. Everything goes up and down. So how much are you willing to risk on the trade? And no position should be, more than a few percentage points in your overall account size. So the biggest mistake people make is going all in, maybe because of something they read on Reddit, maybe somebody's told them something on Twitter, maybe they saw an email, and they're making their decisions based on an article that they've read, which millions of other people have also read. So there's no edge in that. So
Yeah, agreed. So how do you come up with your ideas? Like, are you just following other people? Are you looking for, like, how do you, like, give me an idea of how you would come up with your trading ideas?
yeah, great question. So when it comes to day trading, it's all technical. So we're looking at, things that are opening up or down that day. And we have specific micro patterns that work on 1 minute chart, 5 minute chart. And we're just simply executing on that. Right. So I scan for it every morning. I wake up, I look at what stocks are in the news, what stocks are gapping up or gapping down, what stocks had an earnings or an upgrade, and then I usually make my watch list. I try to limit it to 10 stocks that I'm looking at, and then I might only end up trading 3 or 4, right, out of those 10. So that's my day trading strategy. When it comes to investment, I'll start with a top down approach, meaning I'll start with a little bit of fundamental, but not the fundamental people look at, like this company or the PE ratio or balance sheet. None of that. Mostly just what's my feel on the company, right? I'll start with that. And one of the things I learned from a pretty popular VC firm, Sequoia Capital. So I met with one of their managing partners, and it was very early on when I was in my career. And he said, "Hey, just 2 questions you need to ask yourself. Right. Is this company you're investing in going to be more relevant or less relevant in the next 5 years? Right. Are this company going to have more users or less users in the next 5 years? Right. That's the only 2 questions we ask. And then based upon those questions, then we'll do a drill down approach. Now we'll open up the charts and say, okay, let's say I believe in Tesla. Tesla's at 500. Is it a good buy? Well, we look at the chart and it's straight up, and based on reversion to the mean, what we know, we're going to get a snap back. So then we don't buy it there. We're going to look to buy the pullback, which we did, earlier this year on Tesla. So that was the example of one decision that we might make. But it's typically starting with the feel on the company, going into the monthly time frame, and looking to buy as close as we can to the 21 or the 50 period moving average. That's a very simple strategy to use.
Okay, great. Now, one thing you mentioned was risk management, and I wanted to, I guess, get maybe a little bit more into the weeds here. So, if people are investing, most investors don't have risk management in their portfolio. Their risk management is diversification, which is volatility management, not risk management. So, how do you calculate risk management with your trading in a way that protects you from yourself or bad market conditions or whatever else it might be?
Yeah. So when it comes to swing trading, let's say, for example, no trade is more than 2% of my account, right? That's just a hard, fast rule. I never break that rule ever. I'm not saying 2% the capital that I'm putting onto the trade, the risk on the trade. Meaning, example, let's say a stock is at $100, right? And I buy it, and I decide that if it goes down to 99, let's say, okay, and then I'm gonna get out. So I'm risking basically $1 per share. So then I decide, okay, if I want to risk $10,000 on that position, I'm okay losing 10,000 if I'm wrong. Well, then I do the math. I say, okay, my risk is $1 per share. I can buy 10,000 shares. So if it goes down $1, I'm going to get out of my 10,000 shares and I'll lose exactly $10,000. So my risk is defined well before I even get into the trade. And what I also do is all of those trades will be the exact same risk unit. So every trade I'll risk 10,000 on. So then it's just a matter of probability, that if my probability statistics hold true and I win, let's say my average winner is 2 times my average loser, then I know by that ratio, I only need to be right 4 out of 10 times. If I'm right 4 out of 10 times and my average winner is twice my average loser, then mathematically it's impossible for me to lose money. So I make sure, though, that I don't vary my risk. Not like, hey, Tesla, I'm going to risk $100,000. On this trade, I'm going to risk 10. Now your ratio is all messed up, because what if the $100,000 trade loses and the $10,000 wins? Now you're still losing. So I try to keep the same exact risk on every single trade and let the probability take care of itself. And that risk number will never exceed 2% of my overall account size. So that way I can afford to take a string of losses should they come and still not lose a whole lot. I could lose 5 in a row. What did I lose? 10%, right? But typically you're not really going to lose 5 or 10 in a row.
So, what about kind of one-off events? Like sometimes things just happen, and things gap down, or I mean, gapping up isn't a problem, but sometimes they just gap down and blow through your risk parameters. So, how do you handle that?
Yeah, so I just call it, take it on the chin, because what's also going to happen is you're also going to get stocks that are going up in your favor, right? So if I buy something at $100 and let's say my target was 105, next morning there's some news, it opens at 110. So I made more than what I was supposed to make on that trade as well. So in a long enough sample size, right? Now, sure, you might have 1 month where something just gaps down, horrible news, and you lose way more than what you expected to lose. But in a long enough sample size, at the end of the year, there's going to be some that gapped in your favor, some that gap against you. I call it all just evened itself out. So just having a longer term approach rather than judging myself based on day to day, week to week, month to month. I judge myself just like any other company, quarter to quarter, year to year.
Okay, that makes sense. Now, one last thing I wanted to kind of get into is you mentioned earlier in the show that you're investing in like I think 22 or 23 angel investment companies. So that's a very different style of investing. So why invest in private company stock that you can't get out of?
Great question. I mean, honestly, in this environment, I'm not going to recommend that. I haven't made a single new angel investment for the last 1 year. It's all the investments I've already previously made. But the reason is because if you look at the statistics of investing in private equity companies and using the same approach, like the wrong approach is people saying, oh, this is the next Uber and just putting all their eggs in it. Because I can tell you 90% of angel investments goes to zero. They'll go bankrupt, you'll never see an exit because the only way to make money is that if they go public or they get bought out or they merge with somebody else. If they stay private, even though they're doing really, really well, you might not make anything out of the investment. So I take the same exact diversification approach, purely expecting 90% of my investments to go to zero, but that 10% of those that end up really being, let's say, the next Uber. Like I've had a few exits where some cannabis companies a few years ago had a drone company, there was 30, 40x returns, right? On those things. So when you average it all out, statistically, let's say stock market gives you 10%, angel investing typically gives you about 19% if you do it the same way with the portfolio. So that's one of the reasons I do it. There are secondary markets for it though, although not really accessible to everyday people, but there are secondary markets where people buy and sell their own shares of their private companies as well. So there's always a way to get out, but it's just way harder. It's not as liquid of an investment as a stock market.
Yeah, I mean that seems like an entirely different skill set, right? I mean, you got guys like Tim Ferriss who used to talk about how he did it years ago and he stopped doing it because it just required too much of his time. And there's so many reasons. I mean, I know some people that do it for fun. I don't know a lot of people who do it for gains. I mean, they some of it, but angel investing is a little bit different. I mean, private you have venture capital and private equity, that's different. But angel investing it's kind of like you're buying a lottery ticket, and I don't know. I haven't seen too many people do it as a theme. So that's why I'm curious. So I don't know. What are your thoughts on that?
Yeah, I think for most people, I wouldn't really recommend it because I didn't angel invest until I had a good chunk of money saved up from actual investing and trading. So the first thing everybody should focus on is just do the invest in the stock market, build some cash reserves, build some liquidity, and then I call it my risk money, right? So a percentage, which usually is like less than 10% of my overall income or my overall net worth, is the only what I'm going to be putting into angel investments. So if I lose all of it, well, great, I lost 5% of the overall money that I had. But it's also a good way to do it. But you have to have a portfolio approach. It is absolutely a lottery ticket if you invest in one or two or three companies, right? It's a lottery ticket. The odds of it becoming the next Uber are extremely low. But when you have 30, 40 companies as a portfolio, then the same thing applies, right? 90% are going to go to zero, 10% end up getting bought out, and then you averagely still get that 18, 19% annual return when it comes to angel investment. So I've had some good exits. Cannabis sector was really hot in 2019 and 20. Those were some of my great investments. Two of those companies went public, and I was in it for 30 cents a share as a private investor. They opened at $15 a share. So that was obviously a great return. There was a drone company as well that probably still exists, Dragonfly, I think. That's one I invested in at like 20, 30 cents a share. I don't know where it's at now. But that one also at one point went up to like $20 a share. Although I was still in my lockup period, so I couldn't sell. So I had to sell on the way down. So I didn't capture as much as I could have.
Yeah, yeah, it's definitely interesting and different. So, um, anyway, so yeah, so Anmol, I just wanted to kind of wrap it up here. So, final thoughts you can leave our listeners with, and where can people find more about you?
Yeah, definitely. I think the final part I would leave people with is just, be a person, be a man or woman of integrity. And the same thing applies to your investing, right? Do what you said you're going to do it when you said you're going to do it. Don't turn a trade into an investment, right? And don't turn an investment into a trade. Stick to the plan that you followed. That'll serve you really, really well going forward. As far as where they can learn more about me, they could go to livetraders.com. They can, make a free account, get our free introductory course, free guide, and there's hours and hours of free lectures on our YouTube channel. Just start there if there's something people are interested in. And for reaching out to me, Instagram or Twitter is usually the best way to do it. My username on both of those is Delta90, spelled out DELTA NINETY. had that username a long time ago. Then it got verified, and I want to change it, so I just kept it like that. So
Nice. Well, Anmol, I really appreciate you coming on the show and sharing your wisdom with us. We'll definitely get back to you in the future.
yeah, definitely, it was great chatting with you. Thanks for having me.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right. Well, that was a great interview with Anmol. Really appreciate him coming to the show. Lot of fun in that interview. I always like talking to people who are in that space because they just have a different perspective than most people. And it's always good to get different perspectives when it comes to investing. So now we're into the panel portion of the show where we have our very own Phil Weiss. Hey, Phil.
Hey, Kirk. How are you today?
Good. Well, glad to have you on, and it's just gonna be me and Phil today because it's the last week of summer, and apparently everybody else is at the beach. So just me and Phil are the only ones here. Or Phil and I guess to be proper English. Phil and I are going to be here just holding up the fort and keeping the vandals at bay. So Phil, what were some of your takeaways from the interview?
Well, the first thing I'll say is when I saw the topic, I was like, oh, it's just not something I've ever done or had any desire to do. The closest I got to it was earlier in my career when I kind of got my start in the investing space. I wrote for the Motley Fool back when they had online portfolios and helped manage one. And for the subject to one of my articles, I went and took a one night day trading course. It was like 3 hours. And I walked out of that and I'm like, yeah, there's just not anything I could ever do. And the guy just said, I come in the morning, I pick some names, I watch them on the screen all day long. Maybe I get up to go to the bathroom. That's about it. And then at the end of the day, I leave. Now, Amal had a shorter day, so that was good. But I just couldn't do that. He didn't, you don't know anything about the companies. And to me, that's one of my favorite parts of investing too, is getting to know the companies. And when you're day trading, they're just tickers on a screen. You don't really know anything about them.
Yeah, it's interesting. You said we just sit down at your computer and get up for the bathroom. Like, isn't that how we all work? Like, that's what my day's like, Phil. I don't. Maybe I can be a day trader. Oh man, it's interesting. We just had an episode earlier that we're in last week. We're doing a bunch of these, so we did an episode earlier. We're talking about the office space and how people are working from home. And it's like I have a much more enjoyable experience when I'm working from home. So even though I'm sitting at my desk, at least I'm around family. So but getting into this a little bit though, and I found a lot of interesting parts to this, but So obviously, Phil, one of the reasons we brought you on here is to bring some contrast to the interview, because we don't want to just reiterate everything that was said in the interview. But your style is a little bit different, your approach is a little different, but there's also some things that you probably do the same. So can you talk about some of the things that you do similar to like what Amnol was talking about? And you're not a trader, you're more a fundamental investor.
Yeah, I mean, one of the things that he talked about that I was kind of surprised when he talked about how he has a process, and I like his risk management, where he talked about, I define a level at which I'm going to invest. He invests the same thing in every stock. So it's kind of like you think about when I'm investing in a diversified portfolio, I know how much is going to each thing. So does he. So there's some similarities there. Risk management is part of the process. So there are some ways that I was pleased to hear that there were some similarities, and it wasn't just here, I'm going to pick this, I'm going to pick this ticker, I'm going to watch it go, and when it moves up a certain amount, I'm going to get out. I mean, that's part of it, but there's a lot more control on what he's doing than I expected.
Yeah, I think from everything I've learned about, traders, swing traders, day traders, all scalpers, all the different types, is if you don't have a process, you get blown up. Like people go in, they're like, oh, it's easy money. I just, chase dots around the screen and just buy and sell and buy and sell, and it's easy. And it's not. Anybody I know is worth their salt at this, who's done a reasonable job, has a process, right? And you have to follow the process, whatever it is. Like everyone's got a different style. Maybe the process, you do A, B, C, and D, and then for entry, and then, HIJK for the exit, right? And if you don't follow that process, you can make mistakes. And computers do a better job at this than humans, because humans make mistakes because we get emotional. Oh, great. I'm going to keep letting it go up because it's going to go to the moon. When you said you get out a certain price, you're like, oh, it's going higher, I'm going to keep it. Or if it goes low and you're like, I don't want to sell it yet, it'll come back. Whatever the human psychology is in your head that's preventing you from keeping the right decision, having a process keeps you in line with where you want to go, right? And rightly or wrongly, we can go back and look at history and say, hey, I could have done this and would have made more money. No, you gotta like just shut it off and say, I don't care what happened to the stock after this. I made my money, or how I want to do it, and moving on. And I think the same principle holds true for fundamental investing too. I've had some people who are fundamental investors who had certain rules, like once I sell, I don't look at a stock for 6 months, right? Like you're buying and you're selling and you're saying, all right, I'm out. I'm not going to look at the stock again for 6 months because it's going to bait me to get back in for whatever reason. And so do you have rules like that when you invest, Phil? Or how do you kind of, from a fundamental standpoint, like what rules and processes do you have that are kind of a similar way that people can apply?
Well, before I get to that, there's one thing that you said too that just always strikes a chord when I hear it, because when I think back, one of my favorite books on investing is Common Stocks and Uncommon Profits by Phil Fisher. And in that book, he has a line that something along the lines of this: more money has been lost by investors waiting for a stock to get back to even than almost any other way. And that's like one of those process things where you can't just sit there and wait. Oh, I bought it at 100 and now it's at 80 and I'm not going to sell it till it gets back to 100. It might not ever get there, and you're just going to lose more. It just doesn't always happen that way. In terms of process, I mean, the biggest thing for me, for most of my clients, when I'm investing, I have an allocation and I stick to that. And, if a client has 60% stocks and 40% cash and fixed income, I use what I call tolerance bands to tell me when to rebalance. So that means if it gets to 55-45 or 65-35, that's my trigger for when I rebalance. When I'm looking at individual stocks, it's a little bit different because I'm trying to put a value on them. And I know that value is a target that we don't really know what it is. We all have our own opinions of value. So if it's undervalued, is obviously you want to buy it. If it's overvalued, you want to sell it. But I don't have specific criteria. Normally, it's going to be a deterioration in the fundamentals of the business is going to be the biggest thing that's going to make me want to sell. On the positive side, if we have big gains, that's more likely to sell when it gets overvalued. Like NVIDIA, I know that stock's gone to the moon. It's not easy. I couldn't buy NVIDIA at these levels because it's just too expensive. That
PE of 200.
Yeah.
So, all right. So that's good. That's good. So you're more of the allocation perspective. So what's your process around changing the allocation? Does it ever change? Does it change with the times? Is it more like 60-40 kind of like permanent kind of perspective, or how do you look at that?
So there's two ways I look at that. So I do ask risk tolerance questions to get an idea of how much risk or volatility people can handle. But I also want to look at their financial plan, because to me, the whole point of investing when you are investing for the future isn't to build the biggest pile of money. It's to be able to live the life that you want. So I don't want you to take on unnecessary risk. So I want to kind of marry what it looks like your risk tolerance is with your plan, because I don't want you to take on more risk than you need. And the other thing I just want to talk about, and I mentioned this before in terms of process, I think that's, to me, is one of the most important things, no matter how you invest. You always want to have a process. And I mentioned it to you that Michael Mauboussin writes a lot about behavioral investing and things like that. And he has a grid where it's, outcomes and process. And so if you have a good process and a good outcome, that's a good decision. Sometimes you can have a good process and a bad outcome. That's kind of bad luck. But when you have a bad process and a good outcome, that's kind of dumb luck, right? Because you just got lucky. And the point there is, you really want to have a process that you defined and stick to it. Because if I don't do that, I'm never going to know, was it the dumb luck that made me successful, or was it my process? Sometimes your process doesn't work and you have to make changes to it. But you have to at least have a process that you can stick to, that you can evaluate to see if it, what, to be able to tell, or at least have an idea, are you doing things right or wrong?
Yeah, no, totally agree. I mean, it comes back to we had Annie Duke on the show, I don't know, 9 months ago now. And she talked about her book Quit. And that was one of the stories where she talks about Pete Carroll in the Super Bowl and made the decision. And it turned out to be a bad outcome. And, he came on afterwards and they're like, why'd you do that? That was really stupid. He's like, no, it was the right decision. It was just a bad outcome. Like, and distinguishing between decision and outcome is really important when it comes to investing, because you could make a good decision and the outcome could go against you. And that happens, right? Not every trade's a winner. It's like people think you're going to day trade and you're just going to go in, everything's going to be a winner. No, like there's different styles. Some styles are, you could look. So let me give you an example. There might be one style where you get 90% winners, but every winner is like 1%, right? Like, so it's a small benefit. And you might have a 90% losers model where 90% of your trades are losers, but you end up making huge returns because the winners go up like 1,000%, hypothetically, like just saying. So the point is, it comes down to the numbers, right? You could have a system that's 50-50, and you might say, well, 50% winners, 50% are losers. But like, well, you're not making any money. Well, that's not true, right? If you look at George Soros, he talks about this a lot. It's like, I let my winners run and I cut my losers quick, right? So if you have a 5% loss, if you're cutting it at 5% loss, you don't lose more than 5% in a trade, and you cut it, and then your winners make 20, 30, 40, 50%. Well, if it's 50-50, you're going to make a lot of money, right? And this is in some ways, it comes back to like why I like cryptocurrencies as an investment, not for all of your money, right? But for a small percentage, because it's asymmetric risk, right? The upside is 20x, the downside is zero, right? The downside is you lose all of your money, and your upside is you can make 20 times your money. Well, let's say the odds are 50-50, because I don't know what the odds are, but let's just say, for example, it's 50-50. I would take that every day of the week, right? You bet $1, you make $20. You bet another dollar, you lose one. You bet another dollar, you lose one. You bet another dollar, you lose one. And then you bet another dollar, you win 20. Like, the math is ridiculous in your favor of something like that, assuming that the odds are 50-50 of one of the two outcomes. Now, we don't know what the probability is of the outcomes for that, but it's not 100% and it's not zero. It's somewhere in between. So if you look at your investments, you can't just look at one thing. You can't just look at the outcome. The process, as Phil says, is really important. If you don't have a process, you're going to end up losing a lot of money, because as Phil says, dumb luck, right, is effectively the outcome you're going to have if you don't have a process. You might get lucky. Your neighbor and your buddy at the golf course is saying, hey, I just made like 1,000% returns on this angel investment. Like, yeah, that's probably dumb luck, because unless you're an angel investor, that's dumb luck. And if you are an angel investor, you're probably not bragging about it, right? That's not something that really successful investors, they don't brag about their returns. And you see somebody bragging, it's probably because like they don't get returns that often, or
Right.
because they're projecting or some other thing. But you don't typically see like the best investors in the world bragging. Like in some cases, like Jim Simons, like you don't even know he existed until somebody wrote a book about him. Like I didn't even know about this guy until the book was written. It was great. He was getting whatever 70% returns a year with no losing years. Like that's phenomenal. Those guys don't brag because they don't want you to know what they're doing, right?
That's right.
They want to be hidden, right? It's like the wealthiest people in the world. You don't know they're wealthy because the wealth is hidden. It's in different accounts and different entities and whatever. Like there's a reason that success doesn't advertise because it doesn't need to. So just something to keep in mind when you're getting perspective, when people out there are like, oh, I got this return. I'm like, good for you. Like, did you get it every year for the last 20 years? Oh, you did? Is your name Bernie Madoff? Like, it's just not how it works. So anyway, just wanted to bring that context, but also want to talk about a few other things we talked about in the interview, Phil, and get your perspective. So we talked about angel investing. Now you said you do allocations and you have wristbands and things like that. Do you ever look at things like angel investing or private investing? Does that ever kind of enter your world? Because I know you have a background for a lot of this stuff.
So not a lot, because one of the things that makes me shy away is that they're expensive, like the fees, right? Like I have people that say, oh, let's invest in private REITs. Now, some people may, I don't, because when I look at the fees, it's like, they're like hedge funds with 2 and 3% fees and all these other things layered in. There's no liquidity. So it has to be the right person to do that. So I'm not going to regularly invest in those things.
Okay. Yeah, that makes sense. Now what about, let's see. So what about the staying in versus getting out, right? Like this is always kind of an issue that comes up where, people say, well, it's not timing the market, it's time in the market, which I argue is kind of a false statement, because it's not really entirely true. If you were out of the market in 2008, you would have done very well. So I wouldn't argue that that's a great statement, but obviously getting in and getting out, staying in, staying out, like those are big questions people have to ask themselves. How do you look at things like that? Because look, if you hypothetically in 1999, like I don't know what you were doing in 99. I know you were in a different job and I was too. I was just starting this profession. In 99, like everyone was making easy money, right? And if you were smart, you just said, yeah, I'm going to take my chips and walk away, which would have been a smart move. But if you get out in 97, like Jeremy Grantham told people, just get out of the markets in 97, you would have missed out on like a lot of returns. Mm-hmm. And so it's a question of like, what's the best approach, right? Like, what's a better approach? Getting out, staying in. Like, how do you look at that?
I'm generally the one that stays in. I have stocks personally that I've owned in my portfolio that I owned from like 96, 97 is when they were purchased, and they still sit in my portfolio. I kind of take the view that when we decide to invest, we're taking a long-term view that the market's direction is up. You can argue whether these are good or bad, but there's somebody that tries to say, well, here's what your return would have been if you missed the 10 best days. Well, they also don't talk about if you missed the 10 worst days. I get it. But if I'm taking a long-term approach, I'm expecting the market to come back. I'll change my allocation some when we have the market come down, but I don't ever put my cash on the sidelines, because I think the hardest thing for us to do is, I made the decision to get out. When do I get back in? Am I going to wait to where, a lot of times what ends up happening is people that do that, they pull it out, and by the time they get back in, the market's high, or whatever they are buying is higher than it was when they got out in the first place. So they just sat there on the sidelines and missed out on all the gains. Kind of like you said, if you got out in 97 and you missed what happened in 98, 99. Every time, I mean, unless we're Japan, right? Because the Japanese market peaked in the late 80s and hasn't gotten back to those levels. But the US market, every time we've had a big drawdown in the market, we've recovered and gotten to higher levels. Now, it's a lot harder to do that with individual stocks, because I've seen studies that talk about how you have individual stocks, they hit a level and they never returned to it. A great example, if you go back to the tech bubble, look at companies like Cisco and Intel. Those stocks hit levels back then. They've never been back.
Yeah.
Ever. And odds are that they're never going to do it. Now, Microsoft is an exception because Microsoft did hit high levels, and then, you know, the stock looked like a bad investment, and then Satya Nadella came in for Bomber, and all of a sudden that stock is like it was reborn, and it's back to what it was in terms of how it performed. But that's definitely the exception rather than the rule. So many stocks, they peak, they fall, and they never get back to where they are. Some companies just fade away. Others at least have viable businesses, so they stay around, but they're not the company, you know, they're not at the valuations or the prices they were before. But I'm definitely in the camp that I'm a long-term guy.
Yeah, no, it makes sense. I mean, Microsoft, it's funny you bring up Microsoft. It's a great example. It's funny because when Ballmer took over, I had some hedge fund manager friends of mine. I would ask him, like, what do you think of Microsoft? Because it was in the doldrums. It was just flatlining forever. And it was such a good bargain. Like, the numbers made a whole lot of sense. And I was looking at him like, why wouldn't anybody just back up the truck and buy this thing? And they said, well, because you haven't done the math correctly. He's like, if you do the math correctly, you have to take out, I forget the number, it was like $1 billion every year, and you have to light it on fire. He's like, if you do that, it's actually priced correctly. And I was like, what do you mean? You're like, well, Ballmer, he makes stupid decisions every year and buys companies that basically writes down to zero. So basically, you got to take $1 billion and write it down to zero and light it on fire, and then it's properly accurate. And I was like, okay. Okay. And the funny thing is, I heard that from multiple people. It wasn't just like one person making a joke. It was like, no, like everyone's saying the same thing. I'm like, okay, maybe that's why, because everyone thinks this stock is crap. And then Nadella came in and started to actually run the company like a CEO and not some guy who just happened to be one of the starters of the company and just happened to be there, and he got lucky, and he was like, oh, I'm going to retire. I'm like, oh, Ballmer, you take over. Okay, I can run a company. You know, I'm not taking anything away from the guy. He's obviously smart. You know, I didn't run the company, but still, like, it's like when you get to a certain point, you're like, all right, I'm going to spend more time on my basketball franchise that I bought than running a company. Like, maybe it's time to just cash your chips in and give it to somebody who actually knows what they're doing. Nadella's done a great job, and I kudos to him for taking over and righting that ship. He's done phenomenal work. You know, it's still like the big evil like Microsoft company, because they got to deal with ChatGPT and you know, big tech and new tech is kind of like, for me, it's like, all right, you're going to take over the new tech. Like, I'm not so cool with that. Which maybe is why Meta's not doing so hot, because people are afraid of, I don't know. Anyway, they got their own problems, but
you know, I hear you on Ballmer too. Like, you know, the last movie made, and you talk about lighting money on fire. He bought Nokia. Remember, there was going to be a Windows phone. Whatever happened to that?
When he did that,
I knew one person that had one.
And when he did that, just the rain of crap from heaven just started coming down. Every single person who knew anything about investing whatsoever came out and was like, this is the dumbest move. Even the dumb investors were coming out and saying, this is a dumb move. Like,
Yes.
no one thought it was a good idea. Like, oh, we're going to go into software, into hardware. Yeah, that's a good idea. Let's do that. We're going to take our cash cow where we mint money and let's just do something really stupid with it. I mean, Warren Buffett, you know, the best investor of all time, who's a good friends with Bill Gates, you would have thought that would maybe rubbed off on Ballmer. You know, his whole thing was like, we're gonna invest in cash efficient businesses that don't require a lot of capital to run. And so what do you do? Like, I'm gonna invest in a hardware company. Like, yeah, like it's like Warren Buffett investing in a railroad company, which he did stupidly, which went against his. I mean, you know, it's like when people reach a certain age, they just lose their mind, decide like, I'm so smart, I'm going to do the dumbest thing imaginable because I can still make it work, right? Isn't that what's happening? Like, I feel like that's happening a lot.
Yeah, and you know, there's also the line that Buffett says he wants a company that only an idiot could run. So maybe, I guess, he could have bought Microsoft when Ballmer was there and it was down so much.
And it what did run it, and it's still flatlined, and it was still minting money. I mean, you know, you could still light it on fire. It wasn't a bad company. It just wasn't growing because he took all the growth capital and just did stupid. I mean, what was the was it not Vonage? What was the company he bought? The phone?
That was Nokia.
No, not Nokia. The digital phone.
Oh, he bought something from Motorola too, didn't he?
No. It's something we still have in our computers, but I've never used. It's
oh, you know, it was Skype.
Skype, that's what it was. He bought Skype,
Yeah.
and I'm like, why the heck? There must have been IP in there, or there must have been customer lists, because whatever happened to Skype? I guess some people it still exists. It still shows up on my Windows, whatever version it is. It still shows up there. I don't think anybody uses it, but it's still there. So
No, it's been replaced by Zoom and Teams and Google Meet.
no, but it's still on. I can still find it. It's still in my apps, right?
Yeah, I
I
remember
still
when
have it here somewhere. Anyway,
my
have to
oldest.
bore the listeners with this.
Yeah. All right.
Anyway, so we can kind of like wrap it up here, but any final thoughts here, Phil, about kind of this world of investing that, you know, some people are into and some people are not?
So I'm going to go back to tie one thing that Amnol said to what you were talking about too, in terms of success. Like I liked when he pointed out, he said, if you follow the system that he's using, he only has to be right 4 out of 10 times, right? Because he said, I set it up so that if I get, if I put $10,000 in, I think it was, if I make $2,000, then I'm out. And if I lose 1,000, then I'm out. So if he can do that, he doesn't only have to be right 4 out of 10 times to make a profit. So it's all about having, that's just another thing, have a system, make sure you have a process. Like those things are really important. And then the other thing I wanted to touch back on something else that you said, we were talking about risk and how much you can lose. Like that's why a lot of people don't short stocks, right? Because when I buy a stock, the most I can lose is what I invested. So I can have 100% loss. If I short a stock, my loss is unlimited because there's not a ceiling on where the stock goes to. I know I can sell it, but it's just a lot more risk. So you want to make sure that you think about things like that when you're investing. But the key takeaway to this and in any investing to me is the importance of having a process.
Yeah, no, I think that's great advice. Process, as I like to say, I don't say this on the show, but the process is the goal, right? It's putting together the process, and the outcome is the outcome, right? You can't predict the future, but you can predict your inputs, right? And
yes,
if you do the right things, you will get an outcome that you want, assuming that your system works, right? And you'll get the outcome you want. It won't always be exactly how you see it. You could get a string, like you talked about, a string of 15 losers in a row. At some point, you got to catch it and be like, I'm wrong, right? There's the difference between that. But if you've done the work and you've done a lot of the hard work to put together the system and make sure you understand all the parameters, right? Because part of the you're building this machine. If you're day trading or investing, whatever it is, you're building a machine, right? And the machine is basically your brain. Here's how I think about investing, right? And it has certain inputs, certain outputs. You're taking in the data. You're saying, based on this data, I'm going to do X, Y, and Z. And if you can put this into a computer program and make sure it happens and your system is sound, you'll get the outcome you want, right? Not many people can do it because emotions come in and it's just like putting sand in the gears. Like emotions kind of wreck it. But if you can put together something that's solid, and like you have to have, one of the things that comes up is like knowing when you're wrong. And you have to ask the question of yourself always, no matter what you do for investing, you have to say, all right, where am I wrong? That's the first question, is where am I wrong? And this next question is, how am I going to know if I'm wrong? That's the next question you have to ask. Because if you don't ask those two questions, then you're just a pie in the sky investor who thinks everything goes up. And we've been fortunate for the last, 15 years or so, where markets have just gone straight up. We've had some speed bumps for sure, but the market's just, look at COVID. The market dropped like 20 to 30%, yet you ended up the year high. Like, what world is that reasonable? So we've been fortunate in many ways because the system has buoyed stock prices, but at some point it's not going to go in your favor. And if you don't have rules in place that say, what if I'm wrong? If you think the stock market is going to go up 50% from here, you have to ask yourself, how am I going to know if I'm wrong? And on the alternate side, as Phil said, shorting is a mug's game, because even the best shorters in the world, Jim Chanos is a good one that comes to mind, really good at shorting. Even he'll tell you, he's like, I'm not even good at shorting. Like, he might be the best around, but he's like, I'm not even good at it. It's really hard. Like, it's like everybody's got a bullish bias, right? The markets go up 70% of the time, they go down 30% of the time. So shorting is very hard. So if you don't have so if you think that the market's going to go down 40 to 60%, we talk about this in the show. I I have a thesis that I think in the next few years, we're going to see a point where the market goes down 40 to 60%, because that is a more true valuation. Now, it may never happen. I could be wrong. The question I am asking myself always, and this is why I always, I'm pretty transparent in the show. I will tell you what I think. And if I'm wrong, I'm wrong. And I'll tell you I'm wrong. My thesis is not necessarily the end all be all, and nobody's thesis is that. Warren Buffett's wrong. All the best fund managers in the world, they can be wrong. Everybody can be wrong, right? We don't know the future. And that's the point. We don't know the future. We can only have a thesis, and we try to prove out our thesis. And the question you have to ask is, how do we know if we're wrong? So for me, if I think the market's going down and I'm shorting the market, I'm not shorting the market, by the way, but if I was predicting it was going to short, I have to say, well, what if I'm wrong? And what is the marker that's going to show me that I'm wrong? Now, if the market goes up from here, if it, we use a combination of fundamental and technical, and so it's not just like one style or the other. We use a combination to come up with the thesis. And if I look at it and say, if it reaches this level, I'm wrong, and then we go the other way and we go with it. Because if you don't, then you're pretty much like, I won't name the name, but there's a guy, and he's a famous guy, who was telling you that the dollar is going to go to zero and gold is the only investment and you should short the market. And he was saying this in 2009. And he said this up through, pretty much he's still saying it. He's a perma bear. And if you had listened to his advice, you probably would have lost all your money after year 2. And he's still saying it because it sells newspapers or newsletters or whatever he's selling. It sells gold in his case. But the point is you have to have a marker that says, I am wrong and I need to reassess my assumptions and maybe go the other way. George Soros says and people hate Soros because for many reasons, but one of the things he's really good at is he's a good trader. And the mark of a good trader is this. It's not just looking at a position saying I'm wrong, but it's looking at a position saying I'm wrong and I'm going to go the opposite way because that is the best thesis. So it's like I'm shorting the market and realizing, oh, it's not going down anymore. Now I'm going to go long. That is the mark of I forget who the quote is. The mark of I forget if it was Thoreau or Fitzgerald. Somebody said, maybe it was Scott Fitzgerald said, the mark of a genius is somebody who can hold 2 opposing ideas in their mind at the same time and not go crazy. like to me, you say that and you're like, that doesn't make any sense. Like, no, like like if you sit here and think about it, if you can hold both ideas unbiased and think about it without taking a side and just saying, okay, these are the 2 sides, like it's really hard to do, and especially in a world of everybody's taking a side and they're all fighting each other. Like if you can do that, like that's really hard to do, then you're ahead of most people. So Phil, go ahead.
There's one you're talking, one of the things that reminds me of is confirmation bias. You talked about emotions in investing, and whenever I'm looking at an investment, I want to try to find somebody that has the opposite viewpoint of whatever I have, because I want to understand that so I can think about what can go wrong, or maybe they're right and I'm not. So I want to make sure I understand that. I think confirmation bias is such an important thing. And then the other thing you talk about, like those perma bears. I don't know about you, but occasionally I'll get an email from a client because so-and-so said the market's going down. And the first thing I do is I do an internet search for their name. And then I find them and I see, they've been saying this. Here's all these other times they said that. I said, are they right? Maybe they are. Maybe they're not. I don't know. But they've been saying it a lot. And a broken clock is right twice a day too. So odds are that at some point they could be right, but I'm not going to place a lot of stock in what they're saying because they're saying that, and then that one time that they are wrong, then that's all you're going to hear about is that one time that they got it right.
Yep. That's probably, if you had one takeaway from this episode, and we covered a lot today, that's probably the best one, is that if you're listening to people, they're going to talk about their wins. They're not going to talk about their losses. It's like your neighbor who went to the casino and won $1,000. Did they tell you the 50 other times they went to the casino and lost money? No. They talk about the one winner and you assume, oh, this person's lucky. I want to go with them. Like they're really smart. No, they just don't talk about all the losers. They talk
Right.
about the winners. And, one of the reasons I don't talk about investments on the show is because our regulators don't want me to. But the other reason is it's not going to help anybody, right? It's like when I go for the holidays and I go see family, it's my profession. People are like, what should I do? What should I do with my UPS stock? What should I do with my Apple stock? What should I do with this stock? And I'm just like, first of all, like, I don't want to talk about this crap because it's family and it's holidays and I need a break. But, but I tell them, I said, look, I'd love to give you advice, but I can't, because here's what's going to happen. I'm going to give you advice. It might be right today. It might be wrong 2 weeks from now. You and I are not going to talk in 2 weeks. So I'm not going to be able to tell you to sell it. And you're going to hold on to it. And you're going to say, oh, it turned into a loser. You were wrong. I'm like, I'm not managing your money, man. Like, so I just stopped giving people advice. Like, and I think it's hard because people listen to the show, they want advice, which is why we talk about mental models, we talk about mindset. The most important thing you can do is have the right mental models and mindset about your investing. You're going to have more success there than anything else. Me giving you a stock tip is not going to get you there. That's just going to give you a trigger. So, and I hate to say this because, Amnol is what they do is they do stock trading and whatnot. And that's valuable for people who do that. For normal investors who are not day traders, who do not have systems and processes and risk management in place, you're just taking one idea and you're just saying, this is the idea. It's like taking one piece of insider information, saying, this is the insider information I'm going to put all my money in. It's just not smart. And it's certainly not smart for me or Phil or anyone else to come out here and say, this is a good stock. And if you listen to people say that, you should think twice about listening to them, because it's not the right thing for you, right? If they're talking about what they're doing, fine, right? That's fine. If I come on this week every week on the show and I say, here's my portfolio, here's what I'm doing, here's what I did this week, that's fine. It's just reflecting back. But if I'm coming on saying you should invest in this stock, it's irresponsible. Anybody who says that's totally irresponsible, because they're not there managing it, and they're not there to tell you to sell it. They'll tell you to buy it, and then a year later, and I hear this all the time in podcasts, like, oh, you told me to buy this, and they're like, yeah, I sold it 2 weeks later. Like, you didn't tell me to sell it. Like, so you can't play both sides. So I really despise people who are out there doing one-sidedness. And I have an ethical concern about doing that. And we do make some claims, and they're all on the show, but I don't come back and brag about the wins. I brag about things I tell you every week. And I'm like, yeah, we told this on the weekend show. And I keep saying it over and over. We told you this, because people don't listen. But it's not about investment. It's about a thesis. It's about macro themes that are going on. That kind of stuff is what we talk about, because you can do whatever you want with that. If I say inflation's going to go down by the end of the year and it could be zero, maybe it's true, maybe it's not, but that is a theme. You can't do anything with that. You're not going to invest in the CPI, right? That's not the thing. So it's important to understand. I just say this because it's, what Phil said is so important, and people don't realize this. It's the second level thinking of knowing like what people are saying and why they're saying it. And you need to put everything in context and just take it with a grain of salt and just say, how does this work with my view of the world? Does it improve it, or is it useless to my view in the world? And can I learn from it? So that's why we do what we do in the show. We want to educate the public. We want to give people the right mental models so they can be better investors and make good investment decisions. And obviously, if you want someone to manage your money for you, we do that. Phil does that. Doug does that. All the people on our show, we have a lot of really smart experts in the show that you can pick from. But if you don't take anything else in the show, please take that away, because we want people to be better investors. Even if we're not working with you, we want the world to be a better place, and we want smarter investors. So that's why we do the show. So Phil, why don't you kind of wrap it up and give us final thoughts and where people can find more about you?
Thanks, Kirk. So one thing I'll just add to that, I'm a CPA, and so I had a career in taxes before I did this. I don't really do tax returns anymore, but I tie it into the work that I do, is I think taxes and investing are joined at the hip. But people ask me for tax advice, just like they ask for stocks. And so a lot of times I'll answer, but I'll preface it this way. Remember that you get what you pay for. And what I'm about to give you, you're not paying me anything for it. So you can take it and do with it what you want, but it's free. And it's the same thing when you get stock advice on a stock. It's somebody's free advice. And that was good for them on that day. But like you said, 2 weeks from now, even tomorrow, it might not be good for them anymore, but they have no obligation to tell you. So you're not going to know that.
Yep.
So I'm Phil Weiss from Apprise Wealth Management. Check out my website, apprisewealth.com. You can sign up for my blog. You can download my free ebook at apprisewealth.com/ebook. And thanks for having me, Kirk. Enjoyed the conversation.
Yeah, thanks for coming on, Phil. Always enjoy our conversations. And yeah, check out Phil. He's, as we say in Boston, he's wicked smart. Being a CPA and an investment advisor is certainly no small feat. So check out Phil. He's he has a certain niche which we'll put on the show notes as well. That's the show for this week. Thank you again for joining us in Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com, and of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.